My name is Miranda Chook, a CPA. There are many ways to construct a business budget. One way is to start with this year's actuals, or this year's actuals plus forecast, and calculate an estimate for what the next year or following years will be. Many companies do this by function, and then they'll add them all up, roll them all together. And once they do this, they find that sales sometimes needs to increase by some astronomical amount because of all the spending all the other functions went to do. Thus, the give and take in multiple versions of budgets begins. And this is why budget season feels like it takes many months, and actually does take many months. Now, in all seriousness, many sophisticated what-if scenarios are usually built as well. There is usually some base budget where management believes that the company can achieve in terms of sales and what expenses need to go along to support those sales. But then the what-if scenarios may include what if sales do not what if sales fail to meet that particular budget by 10%? Or what if the sales are at that amount, but costs are actually higher by 10%? These are just some of the many examples. Another type of business budgeting includes what is called zero-based budgeting. Sometimes if a new business line is being launched, companies may go with the zero-based, which basically means that there's no expectation necessarily, or no actuals to build off of, and you really are estimating the quantity of units that you think you'll be able to sell at various prices. And then, of course, what are the corresponding costs, not only of manufacturing, but also of the sales effort, also of the accounting effort that will go into supporting all those sales.